We know Jack Ma has wanted to be very conservative in this pricing, but do you think this is perhaps a sign he should have been more aggressive?
I don't think so. This is a huge deal. This is over $20 billion they're trying to raise on a global offering. That's a lot of stock to place. And number two, I think they're also sitting back and saying we need to be cautious because the last thing we want to happen here is a Facebook-type IPO debacle where our investors get hurt day one. So I think they're being a little bit conservative on valuation. It's still a big deal. It's still a big valuation. It's still a big multiple. But they could, in fact, go higher. But they're trying to ensure, I think, that this deal trades well in the aftermarket.
Why the game of cat and mouse, though? Alibaba knew going into this that demand was going to be, shall we say, healthy,
right,
especially if it priced at $60 to $66. What value does Alibaba get out of playing this sort of game while building the book?
Right. I think what they're trying to do and what the underwriters are trying to do is maximize the proceeds to the company and to the selling shareholders while at the same time trying to ensure that the stock trades well in the aftermarket such that the IPO shareholders, who are in fact taking a risk investing with a new company, that they get an immediate return on that investment. So it's very much a cat and mouse game. It's very much a supply and demand game.
So David Ebersman, the former CEO of Facebook, did not want IPO investors to enjoy a first-day pop. That was part of the reason why they priced Facebook shares as aggressively as they did. Should we assume, from what we can gather, that Jack Ma couldn't care less?
Well, I don't think Facebook management did not want its investors to make money and went to the IPO.
No, they just didn't want it to be unseemly.
Yes,
right? They didn't want a 20 or 30 or 40% pop. They were looking for something like 10 to 15
money on the table. I think in that particular instance, in hindsight, they obviously and the underwriters mismanaged and they misperceived the demand in the marketplace. They thought there was much more demand well above the IPO price, and clearly there wasn't. So that was a failure on the underwriters and the company, quite frankly. Here, Alibaba, I think they learned the lesson. I think on the margin, and I think the underwriters learned the lesson, and that on the margin they're going to be a little bit more conservative.
But there's also a wrinkle with Alibaba that we didn't see with Facebook. Alibaba has a designated stabilization agent in Goldman Sachs, but there's another stabilization agent out there called the Chinese government, right? Surely the Chinese government, with an IPO as high profile as this, would think about stepping in to support the stock price if it were to experience a Facebook-like flop.
I would be surprised if that happened, quite frankly. I think one of the reasons that Alibaba has got every single investment bank on the planet, save two or three, who did the JD.com deal, everybody's on the deal, everybody's on the hook, everybody's a book-running manager. That means everybody, all those big investment banks, a half a dozen of them on the front cover, all share in the underwriting risk here, and that means that they are all ready to step in and support the stock the first day of trading. So you're going to see a lot of capital there supporting the stock, but I think the key thing here is they're trying to ensure that not only can they place $21 billion worth of stock at whatever price they decide, but that they have a lot of aftermarket buying in this stock without price sensitivity. They want buyers that say, not only am I going to buy at 66 or 67 or $68 a share, but I'm willing to buy a lot more stock, a lot higher.
At 80, at 85. And remember, he's feeling burned because of the first time Alibaba.com went public in Hong Kong. The stock plummeted. Do you think he sort of sees sort of an acceptable first-day pop? Is a 50% pop?
I don't think so.
Yeah, I don't. 10%?
Yeah, I don't think so. I think, generally speaking, you like to see a 10, 15% pop in the stock. That's kind of the underwriting discount. That's kind of the rewarding these IPO shareholders for taking the risk of investing in an untested new company. So we'll have to see how it goes. It's such a huge deal. It's a global deal. We'll have to see how much they allocate between institutional investors and retail investors. That's another indicator of how much demand there is. The more demand there is, the less there's available for retail investors. Typically, a deal will go 20 to 25% to retail. I suspect it's going to be a lot lower this time.